We are live for what is the 187th annual meeting. I'm going to bring in the rest of the group now.
Good afternoon, everyone. The hour having arrived, I will call our annual stockholders meeting to order. My name is Bob Goggin, and I'm the Chairman and Chief Executive Officer of the bank. So on behalf of the Board of Directors, I want to welcome everyone this afternoon to the 187th annual meeting of the Hingham Institution for Savings, our 32nd as a publicly traded company. And while our president, Patrick Goggin, and our chief financial officer, Christian Melech, are physically present with me here at our corporate headquarters in Hingham, we also have with us this afternoon our entire board of directors, each of whom are attending via Zoom. We also have present with us Mr. Arthur Regan of Regan Associates, who has been designated by our board of directors as Inspector of Elections, as well as Martin Kane from our external auditors, Wolf & Company, and Samantha Kirby, our counsel at Goodwin Procter. So I welcome all of you. And we're going to conduct this meeting in three parts this afternoon. First, we're going to conduct the formal portion of the meeting that involves those three proposals that are contained in the notice of meeting. Once we've addressed those items, we will conclude the formal portion of the meeting. And next, as has been our tradition for many years, we're going to recognize one of our colleagues who has contributed in an outstanding fashion to the success of the bank this past year. And thirdly, I will ask our president, Patrick Goggin, to review with us the financial highlights and achievements of the bank since we last met. And then we'll open up the meeting for questions. So before we begin the formal portion of the meeting this afternoon, I want to review a few housekeeping items with you. First, this meeting is being recorded. And second, all general attendees are participating in listen-only mode. When we do reach the Q&A section of the meeting, I want each of you to feel free to raise your hand, and we will unmute you and turn on your video to participate. If you would prefer not to participate via video, feel free to submit questions via the Q&A feature in Zoom, and I know that a number of shareholders have already submitted such questions, so that's great. Third, as noted in our proxy materials, all voting will be either in person or by proxy. Electronic voting is not available. So with that, we'll begin the formal portion of the meeting. And we're here today to consider the following business items that are described in detail in your proxy materials. First, the election of directors. Second, the election of a clerk of the corporation. And third, the advisory vote on executive compensation. We'll consider each of these items in turn as they appear in the notice of meeting. I should note that I've received an affidavit certifying that the notice of annual meeting and proxy statement was sent to all stockholders of record as of March 1st, and that the same was mailed on March 12th. So before I address the business items, I would normally say, is there any stockholder present who's not submitted a proxy and wishes to vote in person? But since I'm here alone in the building with Patrick and Christian, we're not going to distribute proxies to anybody because no one's requesting them. So at this point, I'm going to call upon Regan Associates to furnish us with a count of the shares present personally or through proxy. So Mr. Regan.
Mr. Chairman, there are at least 1,891,827 shares present for today's annual meeting, either in person or by proxy, representing an impressive 88.49% of the outstanding shares.
Thank you, Arthur. So there being 1,891,827 shares of common stock represented at this meeting out of a total of 2,137,900 shares outstanding and entitled to vote, I'll declare a quorum present. So the first matter to be voted on by the stockholders is the election of directors. We have 5 Class 3 directors who've been nominated by the board for 3-year terms, each to hold office until the 2024 annual meeting and until their successors are duly elected and qualified. And those Class 3 directors are Michael Desmond, Robert Lane, Scott Mosier, Kara Smith, and Jacqueline Youngworth. Do I hear a motion that the nominees be elected as directors of the bank to serve until the expiration of their respective terms and until their respective successors are duly elected and qualified?
So moved, Mr. Chairman.
Second.
Second.
Is there any discussion on this motion before we proceed to a vote? There being no discussion, we'll now proceed to a vote. All stockholders present having been given the opportunity to vote either personally or by proxy. I'll ask Mr. Reagan to announce the vote.
Mr. Chairman, each Class 3 director nominee received at least 1,229,047 shares voting for their election, which represents the vast majority of all shares voting on that item.
Given that vote, I will hereby declare that the nominees have been elected as directors. Thank you, Mr. Reagan. The next matter to be voted on by the stockholders is the election of Jacqueline Youngworth as clerk of the bank to serve until the year 2021, until next year's annual meeting of stockholders, and until her successor is duly elected and qualified. Do I hear such a motion?
So moved.
Mr. Chairman.
Second.
Any discussion on the motion? Hearing none, all stockholders have been given the opportunity to vote either personally or by proxy. I'll call upon Mr. Reagan to announce that vote.
Mr. Chairman, youthful Jackie M. Youngworth received at least 1,854,306 shares voting for her election as clerk of the bank, which is almost all of the shares voting on this matter.
Thank you, Mr. Reagan. And given the fact that the holders of a plurality of the shares present voted for the election of Mrs. Youngworth as clerk, I hereby declare that Jacqueline Youngworth has been so elected. Next item of business and last on the formal agenda is the so-called Say on Pay resolution. The proposal calls for an advisory vote on approval of executive compensation. Do I hear a motion to approve the compensation of the company's named executive officers as disclosed pursuant to the Securities and Exchange Commission's compensation disclosure rules?
So moved, Mr. Chairman.
Second.
Any discussion on that motion before we proceed? Hearing none, we'll now proceed to a vote. All stockholders present having given the opportunity to vote either personally or by proxy, I'll call upon Mr. Reagan to announce that vote. Mr. Reagan.
Mr. Chairman, at least 1,469,842 shares voted for the bank's Say on Pay proposal, representing overwhelming support for the bank's compensation program.
Thank you, Mr. Reagan. The holders of a plurality of the shares present are represented and entitled to vote at this meeting. Having voted in favor of the Say on Pay resolution, I hereby declare such proposal to be adopted. As there's no further business to come before the formal portion of the meeting, I would now entertain a motion to adjourn.
I would move that we adjourn.
Second.
Motion having been made and seconded, I will now declare the formal portion of this meeting adjourned. So thank you for your participation in that portion of the meeting. As I indicated at the beginning of the meeting, it has been our longstanding tradition to recognize one of our colleagues at the bank who has really performed in outstanding fashion this past year. So this year, on behalf of the board of directors and all of us here at the bank, I want to recognize Kelly Conley, our director of loan operations, for her outstanding contributions this past year. This year's colleague that we are recognizing really does exemplify the old saying that when you need something done, you should ask a very busy person to do it. Kelly, this past year, in addition to her responsibilities as mother of a very active 2-year-old, and in addition to finishing her last year of law school nights, took on the additional responsibilities that were encompassed in the role of director of loan operations. As part of her responsibilities this past year, Kelly was the point person for all of our borrowers' requests for COVID forbearance or modification. And she did an absolutely outstanding job in that role. As a result of her efforts and the conservative underwriting of our committees, boards, and lenders over a number of years, we experienced the lowest level of forbearance and modifications of any $2 to $4 billion bank in the entire United States. So I know that we're all grateful to Kelly for her efforts, and I want to congratulate you, Kelly, and thank you again for what you've done for us this past year. So it's much appreciated. So with that, I am going to turn to our president, Patrick Goggin, and ask Patrick to take a look at our performance this past year, and then we will go to the question and answer portion of the meeting. So Patrick, I'll turn it over to you. Thank you.
Thank you. And I'd ask everyone to just bear with me for a sec as I switch over to screen share view. We're going to go through some slides that, for folks that have been coming to this meeting for a number of years, will look awfully similar to things they've seen before. And when
Volume's a bit low.
I'm sorry, when we wrap up those slides, I think open it for questions at that point, as opposed to taking them as we go through. And as my dad indicated, either use the Q&A function at the bottom, or if you raise your hand in Zoom, we'll pull you up from attendee status and bring you into panelist. So if you give me one moment, I'm going to switch those screens. Okay, so first off, the safe harbor statement. I'm not going to read this to you. You've read it before. It's available on the internet. It mirrors what's in our securities disclosures. But generally speaking, we don't undertake to give forward guidance. Any forward-looking statements we make or may make have all sorts of qualifiers on them. So again, I'd advise everyone to do a read this, because I'm not going to read it to you. I'd like to touch on sort of three things here, or segment the informal portion into 3 parts. First, I'd like to go through the financial results for 2020 in a pretty similar format to what we did last year. Second, I'd like to touch on some operating highlights and in particular some operational challenges that I think we're facing now or that we see going forward. And then finally open it up for questions and answer. I would very much encourage people to participate in that. This isn't pro forma for us. We like questions. We like this to be participatory. So I'd encourage folks to speak up. There's a fair number of questions that we received in writing in advance. And for those questions, we did our best to group those together. And I think what I'll do is I'll address those first, and then we'll open it up for everyone in the room. So with that, let's get started. A quote that's been in this slide deck for some time, and I think accurately describes sort of the simplicity of the business that we're in. Banking is a very good business unless you do dumb things, which is a true truism. And I think speaks in particular to some of our focus on credit quality, which we'll discuss in a little bit. Most of the dumb things that banks do relate to lending. I think that's where we perceive the sort of majority of bank killing risks, the most serious risk to the model, given the kind of leverage that we employ in the business. So when we think about dumb things, we're generally thinking about the credit function and about assets. Very high level, what do we do? Most of the folks in this call are fairly long-time shareholders and know what we do, but I think that it is always worth emphasizing the simplicity of our model. What is within the model and what is not. First, commercial real estate lending, which we'll sometimes refer to as the beating heart of the business. It's where the majority of our capital is committed on the asset side. It's where we spend, I think, the majority of our time from a board and management team perspective. It is both where we make our money and where we could lose it if we're not careful. So it rightly occupies some pride of place in terms of commitment of time and capital. The commercial and personal deposit banking businesses. Historically, as a thrift, this was a branch network that stretched from here in Hingham on the South Shore and expanded over time into Boston, eventually out to Nantucket. Over time, this business has changed a little bit and has become a little bit more focused and I think relationship oriented with the growth of the specialized deposit group, which we've talked about a little bit in the past and we'll talk about a little bit in a few moments. And it is a relatively simple business. It's the business that we use to fund the asset side of the balance sheet in addition to some of our wholesale activities. And then finally, our residential real estate lending business. This is a smaller business in terms of the size of the balance sheet. And generally speaking, our activities in this business are done as accommodations to customers that we serve in either our deposit or commercial real estate lending businesses. Residential real estate lending is an extraordinarily competitive and efficient market. And generally, when we're active in that market, we are trying to find sources of inefficiency that are problems for our customers. So self-employed borrowers, sometimes borrowers that have foreign tax returns, areas where the efficiency of the secondary market hasn't yet reached, and where we can structure transactions that are safe and profitable, but deliver some real value for our customers. And that really is it. Another slide that has traditionally been in this slide deck is all the things that we don't do. And I think that it's very important to be explicit about all of the things that we don't do using our balance sheet. we might access some of these things indirectly via our investment operations, but we don't do these things. So we are not a C&I lender. We don't do any small business lending. We don't do any leverage lending. We don't do any sort of traditional C&I loans or lines. We don't do any leasing activity. If it's asset backed, we're not lending on it. We are not an SBA lender, although careful observers will note that there is an asterisk here that was not there last year. We did a small amount of PPP lending since the onset of COVID, particularly small in relation to the size of the balance sheet. And those loans were generally for either existing customers or some nonprofits that we felt very strongly deserved to get access to that program. But that was not a line of business for us. And I don't think that we anticipate SBA lending being a line of business going forward at the conclusion of the PPP program. That will end. Consumer lending, we don't do any of it. So if it moves, we don't lend on it. It's a credit card that moves around with you, a boat, a plane, a car, RVs, any kind of personal lines, even overdraft lines of credit. It's not something that we do. Investments, we don't do any investment activity as an advisor for others. So no wealth management, no trust, no investment advisory. This is an area where from time to time we will get questions given the relative affluence of the markets that we operate in. I would say, long-time fascination on the part of bank investors with non-interest income. And I think our view is that these are very, very difficult businesses to execute well. There are a lot of banks that have tried to do this within a bank structure that have never reached scale and don't provide segment level profitability for a reason. And the reason is that those segments aren't that profitable in a lot of instances. So it's something that we've avoided. I think there are a lot of people that do that well outside of a bank context. It's not something that we're looking to try to replicate or compete with. Insurance brokerage or underwriting, another activity that a number of banks in New England, particularly here in Massachusetts, there's one in particular they're very active in. Again, something that we don't touch either operationally or using our balance sheet. The secondary market for residential mortgages, we do residential lending, but we are not a mortgage lender classically, in the sense that we don't sell any of our residential originations into the secondary market. And we don't participate in any of the government-sponsored programs relative to residential lending. So we're not an FHA lender, and we don't sell either GSE or private label or to the home loan bank for residential lending. And that's intentional because it reduces the surface of counterparties that we're interacting with in that business, and we retain the decision authority to do things for our customers in that area that are unconventional and again, add value for them. And that value means that we can charge a little bit more, and generally speaking, we can get larger down payments. We can structure those more safely. We don't do any tax credit lending or purchases, whether historic or new market or low-income housing. We don't do any solar lending or credit lending of any kind. And with respect to participations, we never buy participations from other banks. That is a bright line, hard rule. And 99.9% of the time, almost always, we are not going to sell pieces of loans that we have originated to others. It's not a line of business for us. It is something that I think from our perspective, many banks use as a risk management tool, but that can encourage them to underwrite and attempt to lead transactions that are frankly too large for them. There is, as with SBA, another asterisk here, and that's because we have a relationship with a de novo bank in Washington, D.C., and we have sold, and I think intend to continue to sell some participations to them as we try and help them get out of the bottom of the J curve of profitability. But again, not a business line that we're in. Capital allocation, again, a standing slide. Not necessarily in order of priority, although the more years that we do this slide, the more that I think it probably is organized that way. So first, the things that we find attractive. The number one priority for capital every year in terms of the investment of the incremental capital that we generate is reinvestment in the lending and deposit businesses. So as I think everyone understands, the lending business is a regulated business. It requires risk-bearing capital. To grow the loan portfolio, capital needs to be held against that. So reinvestment in this business means continuing to source and originate and put on the books high-quality loans that we believe are safe. In the deposit business, the same is true. Deposits, need capital held against them. Some of the investments in that side of the business occur through the income statement in the form of particularly technology, but also in the form of people. Finding, recruiting, retaining higher caliber people over time that can manage the kinds of relationships that we have on both sides of the balance sheet. So that's number one. Organic growth is always the first priority. For a lot of reasons, it tends to have the highest returns on incremental invested capital because of the efficiency of that model. Number two, making minority equity investments, both public and private, focused on financial services, as well as technology and financial infrastructure. This is something that we've also talked about in the past. Minority equity investments allow us to leverage knowledge that we develop in our core business and profit from it in these investment operations. And conversely, there are things that we learn in this business that we bring back into the core business in terms of how we operate the business, how we think about capital allocation, and in some cases, certain operational processes or uses of technology. Often, because we're not paying control premia in these investments, we're able to access them at prices that from time to time are very attractive relative to the control premia that would be paid. We'll touch on that a few lines down. Number three, maintaining appropriate leverage through regular and special dividends. We've had long-standing both regular and special dividends, which serve as a release or an escape valve for capital that builds in the balance sheet. There are two sort of different components to this. The regular dividend and its rate of increase over time are really best thought of, again, a phrase that we've used in the past as a Ulysses contract that is a recognition that we may be wrong about the prospective return on the investments that we're making, either the balance sheet investments that we're making or the passive equity investments that we're making. And it's appropriate over time to return some of the incremental capital that we generate to the owners. The special dividend will vary over time. It has been high, it has been low. There have been years in which we've had very significant capital generation. There was one year in particular with an insurance transaction now 7 years ago where it was, I think, very much appropriate to return a larger amount of the capital that we had generated that year because the prospects for employing that capital going forward were probably not as attractive in a 1 to 3 year period, given how much we were earning. But this is something that is weighed in relation to our prospective returns that we have, both in organic growth and in our equity investments. Finally, opportunistic repurchase of shares. As everyone knows, this is something that we have not done historically. There are some operational challenges and there are some tax disadvantages because of the absence of a holding company at Hingham that have made this, I think, somewhat more difficult than returning capital in the form of either regular or special dividends. As we have gotten larger, some of those operational challenges have become less meaningful or salient. And the size of the tax disadvantage, which is related to the bad debt asset, that is a fixed disadvantage. So as the bank grows, the ability to repurchase in size would allow us to minimize that tax disadvantage. Historically, this is not something we've done, and there really have been some significant barriers to it. So it falls at the bottom of this list. In terms of things that are not attractive, and this bears repeating as well, control equity investments in banking or acquisitions. Generally speaking, our view is that acquisitions in the banking industry have not created substantial value for the owners of the acquirers. There are exceptions to that rule, but I think generally our view is that those acquisitions have created substantial value in some instances for the shareholders of the target. They've created substantial value for management of the acquirer, but the prices paid for control are generally an expression of hubris in terms of the ability to manage the both cost savings and revenue synergies post-acquisition. So we think the prices are too high. They can result in a significant loss of focus, and the cost synergy stories are more often than not fairy tales. So, of course, 2021 financial results. This is an error in the slide deck. We're going to be talking about 2020. 2021, we've got a quarter under our belt, and we talk about that later, but I think our focus is on last year. We had a strong year, almost 51 million in GAAP earnings. That includes some significant earnings that were required under GAAP to report, which are unrealized gains in our investment operations. So I would always caution folks that read our reporting to distinguish between our GAAP reporting and our definition of core, which excludes those tax-affected gains, and I think gives a more accurate view of the underlying performance of what we refer to as the core business. It's great that we made more money in 2020 than 2019, but all of our shareholders should rightly ask two questions. The first is, what capital did we require to generate those returns? So what incremental capital did we require to generate those returns in 2020? And then the second is, how are those economics playing out on a per share basis? So I think we're going to look at that in two separate ways here. The first is the return on equity, which is those returns in relation to the equity capital that we employed in the business. For a long period of time, you see 5 years here, we have a longer history in our annual report. We have generated returns on equity in the mid-teens, sometimes a little bit lower, sometimes a little bit higher. 2020 was a uniquely strong year with respect to return on equity, both on an absolute basis. I think at 19%, that was very satisfactory for us, and on a comparative basis as well to other Massachusetts savings banks. I would say that the other dimension, the per share economics, which we reflect here, not in terms of EPS, but in terms of book value per share, were also, I think, fairly satisfactory. We ended the year with just over $137 of book value per share, with a 5-year compound annual growth rate just above 16%, which reflects the growth in book value from earnings, less the capital that's returned to the shareholders in the form of the regular and special dividend. which accounts for the gap over time between the CAGR and book value and the returns on equity that we were looking at in the last slide. In terms of how we delivered those results, I think there are a number of factors, but one of the things that we remain focused on and we believe is a core element of our success is low-cost leadership. Banking in large measure is a commodity business. There are areas of it that are subject to specialization. There are areas where one can develop some competitive advantages with respect to product and service. But by and large, on both sides of the balance sheet, both the asset side of the balance sheet and the liability side of the balance sheet, banks are price takers, not price makers. And what that means is that sustained returns in an industry with that kind of structure rely on taking costs out. The efficiency ratio in 2020 of just over 25% was a strong one, down from approximately 30% in 2019. And this year, it is looking even stronger still. I would note that the efficiency ratio is really the product of what we refer to as structural and operational choices. The structural choices are the choices of what businesses to operate in and what businesses to avoid. In our case, our concentration on real estate lending and our concentration on the deposit side on commercial, institutional, higher net worth customers with higher average balances and trying to get leverage on technology in that area allow us on a structural basis to deliver an efficiency ratio or net margins, not in the banking sense, but net margins that are structurally superior. Operational choices are those choices that you make after you've decided what kind of games that you're going to be playing. So structural choices are really about game selection. Operational choices are about how you play once you've chosen those games. And this is where I think the importance of continuous improvement from processes and the importance of a frugal mindset really come through. And I would give great credit to all of our team in terms of the work they've done over a number of years to produce these results. There are really no silver bullets when it comes to operational efficiency. It's the product of a lot of changes accreting over time and a culture of improvement that's not driven by any one individual, is not the result of an initiative, and cannot be episodic. And it's also a process that is never ending. So when we talk about being relentless and taking unnecessary costs out of the business, I think we still view there being substantial waste, both here at Hingham and structurally in the industry. And we're very focused on taking that out. So we'll go through both sides of the business quickly here. First, the lending business. We have two businesses, commercial and residential. In 2020, I think, again, very satisfactory growth. On the loan side, fairly similar to the long-term compound annual growth rate in that portfolio. Growth is great, but it needs to be done on a quality basis. Growth without quality in financials, whether insurance or banking, can be very, very dangerous. And I think the quality of the originations this past year and the quality of the originations over a long period of time, were quite strong, and I think we're borne out by our performance in 2020. The commercial portfolio in particular is a substantial focus for us, as I described earlier. The reinvestment characteristics of this business are very attractive. Our customers who have substantial portfolios of multifamily or mixed-use properties are acquiring new properties over time. In some cases, particularly in conditions of distress like we saw in 2020, they might even be more active as opportunities become available for them. Whereas in the residential business, generally folks own one home. They might own two. It's extraordinarily rare that they own any more of that. So the reinvestment characteristics of that business are a little bit less attractive. Loan losses, this speaks to the quality that I referred to earlier. It is easy to make loans. It is easy to give people money. It is harder to get it back from them. That's really where the trick is. This is a chart of net charge-offs over time at Hingham and at all FDIC insured banks. So this chart stretches back to 1997. The blue line that you see is the average net charge-offs for all FDIC insured banks in a given year. And you can see that escalate a little bit in the early 2000s, 2001 and 2002. You can see that really peak starting in 2008, but the losses really come through the balance sheets in 2009 and 2010, which was the great financial crisis. So in those years, the average of all FDIC insured banks were charging off over 2% of their average loan portfolio, which is really very substantial. The red line, to the extent that you can see it, is net charge-offs at Hingham. You see in some of the earlier years in the 2000s, there were actually net recoveries. Most of that was associated with recoveries from losses that date back to the change of control in 1993. There are some losses in the great financial crisis. They peak at, I believe, 6 or 7 basis points of average loans in a single year. I believe that was in 2009 or 2011. The 2 years are very similar. We've had essentially no net charge-offs in the last 10 years. There are a number of years there where there were net recoveries. I am disappointed to say that in 2020, we had net charge-offs of about 1 basis point on the portfolio, or 200,000. It was a little bit higher gross, but as observers noted, we were able to recover some portion of that through litigation, which remains ongoing. All in all, 1 basis point of net charge-offs in 2020, I think, was a very satisfactory result, but we liked 0 better. The deposit business, again, I think a very strong year in 2020, although I would caution folks that in looking at deposits across the industry, 2020 was an extraordinary year. There was extraordinary systematic liquidity that was introduced via a number of different channels, particularly via PPP in the industry. So I think we had a good year. We had a good year despite not being a substantial PPP lender, but I am cautious about disaggregating that result and trying to claim too much credit for it. How much of that was alpha and how much of it was beta, I think, remains unclear. The deposit approach at Hingham, I think it's worth touching on this a little bit because it is somewhat different. First, personalized service, which is delivered through dedicated relationship managers, particularly in the specialized deposit group. This is a model that has been adopted in some other banks. I wouldn't claim that this is particularly unique. There are elements of it that we have clearly stolen and copied. Maybe stolen's not the right word. But it is something that does differentiate for larger customers that have more complex needs. Second, digital excellence. I think that it is fair to say that there are table stakes technology deployments that need to occur to compete for certain classes of customers. This is particularly true on the commercial side. There are some areas in which we have been a fast follower, but we have been focused on going fast. I think it's fair to say that this is no longer something that's optional for banks. It's something that we're focused on improving, both in terms of the customer-facing solutions that we deploy for businesses and for personal customers, and also with respect to the internal operations of the bank, because those operations get externalized to customers in the form of problems. So it's not enough to have a really attractive app or website for customers. Technology needs to be used to solve problems inside the bank, because those problems will surface to customers over time. I think finally, and this is where our approach is somewhat different than the industry or conventional wisdom, is that we have essentially no deposit fees. A number of years ago, we looked at this. We looked at this again last year. We have no overdraft protection program. We don't have any fees associated with our commercial deposit products, unless we're talking about merchant services or potentially a high volume lockbox customer where we're working with third parties. But we really don't make money charging fees. And this is I think a long-standing philosophy on our part. I think we've worked to drive these fees down where we can and eliminate them where we can. I think it is reflective of two things. One, this business funds the asset side of the bank where we really specialize. So to the extent that we can attract customers with higher average balances and lower costs, particularly if it's non-interest-bearing checking relationship deposits, the introduction of fees for things like cash management or ACH or wire is likely to undermine what we want to be, I think, a virtuous growth cycle there in terms of low cost operating accounts, low cost deposits. It's just not worth it. Second, those fees, particularly fees like wire fees, which I think a lot of folks on this call are probably familiar with, bear absolutely no relation to our underlying cost to provide that service to the customer. So to the extent that there are banks that have built businesses on fee income where the margins are very, very substantial, that represents a margin or a profit pool that others are going to attack over time. And it is very difficult to make that a sustainable business. Those margins are someone's opportunity to steal someone else's phrase. In this business, there are really two engines for growth. The first being our specialized deposit group, which has two components: the private client component, which is our largest and most complex customers. The second being digital first account acquisition, which we'll touch on. The second engine for growth being the retail banking group, which is the network of branches that we have that stretches from Boston through the South Shore out to Nantucket. So first, SDG. For a number of years, we've talked about increasing our commercial deposit focus. This continued in 2020. It's continued this year. This is a mix of relationship managers and folks that specialize in the deployment of our digital banking solutions. And this is our largest and most complex deposit customer base. It also includes digital first account opening, which remains relatively small. It's about 20 million at this point, and that's something that I think we're still working to crack the code on, and we're looking at some changes from a front-end perspective with a new partner in that area, and I'm excited about that. As of the end of the first quarter, they were responsible for a little over $500 million in deposits, both personal customers or retail customers and business deposits. Those personal customers are generally individuals that have business relationships with the bank. A very strong year in 2020, 31% growth, and a real focus on business development. The retail banking group, being that network of branches that I described, also a very important source for deposit funding for the balance sheet. Increasingly working to develop that network as a single point of contact for both deposit and residential lending. historically, our residential lending effort was, I wouldn't say siloed, but somewhat segmented from our retail branches. And there were folks that specialized only in residential lending. We've made, I think, some great strides in the last year to integrating that with the branch network in a way that adds some value for customers. Over time, the footprint of this network has become considerably thinner. So in the last several years, we closed our offices in North Scituate, in South Weymouth, in Beacon Hill, in Boston. And this coming week, we're closing our office in South Hingham, one of 3 that we have here in Hingham. And I think that reflects our view that those branches in the future are going to be platforms for more business development activity, and I think less transactional activity as customers' preferences change. That was particularly true during the pandemic last year, in which we saw some very substantial shifts in customer behavior. And I think it is probably the case that we'll see some additional consolidation going forward there, consistent with the idea of having a thinner geographic footprint. There's some key challenges that I wanted to touch on before we get to the Q&A. First, the challenge of disciplined growth in new and existing markets. Our commercial real estate business is very much focused here on Eastern Massachusetts and in Boston. We also have I think, a substantial and growing business in Washington, D.C., which we've talked about in past years. That business is approaching $500 million on the asset side of the balance sheet. The deposit business that STG is doing there is somewhat behind that, but I think that's a real focus for us. And over time, as we invest the incremental capital that we generate, those 2 markets have the capacity to absorb very substantial capital at terms from a quality perspective, from discipline perspective, that I think are pretty satisfactory. There are very attractive long-term economic drivers for both markets. The supply of real estate in both markets is a supply that is generally sized in a way that is attractive to us. There's a lot of multifamily product in both markets. There is a lot of smaller multifamily product in both markets. There remains some diversity in terms of ownership in those markets. There are some very substantial family owners of real estate in both Boston and Washington, D.C. It's not simply institutional, which I think is important for us given the relationship focus that we have on the CRE side. But having said that, I think that it is likely the case that there will be additional new markets in the future, and that's something that we've spent some time working on in the last year. Washington has been a project which we really started, probably now 6 years ago, in terms of studying that market, thinking about the market dynamics, starting to understand the real estate, starting to understand the banking market there in terms of who competitors would be, starting to think about the operational challenges involved in lending in that market, both directly for ourselves and in terms of the service providers. So entering a new market takes some period of time. And it's not something that we can turn on overnight. And I think it's worth noting that over the past year, particularly during the kind of depths of the pandemic, the disruption in the San Francisco Bay Area market was something that we found very interesting. We had some exposure to that market sort of at a very high level without getting specific in our equity investment program. And we had some insight into the dynamics of the real estate market there. And I think our view is that the effects of the pandemic are likely to be transitory in a number of respects in the urban markets that we operate in. There are probably exceptions to that, possibly in the office markets. But the long-term trends in these cities are not trends that have been reversed by COVID. And so to the extent that there was a tremendous amount of disruption there in the past year, both in the real estate market and the banking markets, and to the extent that that market enjoys some of the same long-term economic drivers that we see in Boston and in Washington, and to the extent that that market has consolidated from a banking perspective in the $1 to $10 billion range, we felt that it was a market that merited some investigation, which we've started in the last year and have kind of ramped up, I would say, in earnest, particularly this quarter. But that growth must be disciplined. So I think that will be a very slow story to unfold, in the same way that the story in Washington has taken a number of years to unfold as we've gotten comfortable with the operational and underwriting challenges there. Second, scaling SDG. As folks can see from the growth that we've experienced over a number of years, there are a number of things about that model that we think are really attractive in terms of how we serve customers and deliver value to them. That's something that I think we're looking to extend and continue. And in large measure, that is a people challenge. So recruiting and developing really high quality relationship managers in the markets that we operate in is something that we are very focused on in that group. And I think that is a challenge that we're aware of. We're looking forward to trying to solve for it, but that's really top of mind. I think third, and again, this is not really an initiative or a discrete thing, but the opportunities for process improvement and waste elimination are really substantial. And as new technology becomes available to us, or as we think about problems in different ways, there are opportunities to both take cost out of the business and reduce friction for our customers. And that's really just a kind of an ongoing thing. It's always occurring underneath the surface. We're always working on it. I'm always dissatisfied with it. I think that is sort of a perpetual key challenge. I had a picture in the slide deck last year. I was unable to format that picture for this year. Last year, we showed you the outside of a townhouse that we purchased in Washington, D.C. And unfortunately, this photo is not landscape, it's portrait. So I'm going to put this up on the screen. And for folks that saw that photo last year, there is nothing left inside that building. So I was actually down there earlier this week. This is a photo from the inside. Our contractors are well underway there. So this isn't strategic or high level. It is very exciting though. As dirt lenders, we like to get into the dirt. So what you see is them going down about 12 feet from the original floor. And we're going to be underpinning both sides of that building and pushing it out a little bit. And I'm very hopeful that we can get this space done by the end of 2021. There are folks that tell me that it doesn't matter because we've had, I think, a very strong start to the year in Washington without any office space. And our team down there, including Jeff Geifman, who joined us now a little over a month ago, tell me that they don't need to be in the office, but I'm eager to get this done. And so with that status report, I'm going to turn off the screen sharing, and I think we'll open it up for questions. I think what I'm going to do, because I've been talking for a while, is maybe alternate between what we have in the Q&A and what we have in writing here. So I can at least take a 20-second break while someone else asks something. I don't see anyone with, oh, we got two folks with hands raised. Okay, Bob, I'm gonna promote you up first. And then unmute you. Okay, Bob, I think we've got you on. Or is it Rob? I'm sorry, I can't remember.
Bob.
Bob.
Bob is, yeah. Hi, how are you?
I'm doing well. How's the weather in
Great.
Chicago?
Nice, nice.
Good.
Thanks for taking my question. As I look at the bank, it looks like both on the deposit side and the loan side, pretty consistently, you're able to grow at, a really attractive rate, call it 12% a year, which is, way higher than the economy or profits or, things in general. So what, can you help people understand just sort of the economics of that? How does it work? And then what challenges do you see to being able to sustain that over time?
Yeah, I think, so I think I'd say that absent some other factors over a longer period of time, as we generate incremental capital, holding leverage constant, which is not been the case. We've been slowly delevering over the last few years. You would expect the balance sheet to grow roughly in line with retained earnings, which is to say, as we generate that incremental capital and we look to invest it safely, you would see loans and deposits, or more accurately, loans and balance sheet funding, because there's a wholesale component to it. It would grow in line with that. I think that it's important to think about those growth rates in relation to the markets that we operate in. And I suppose in relationship to the economy in general, although I would say that we are so small in the markets that we operate in, and we're so small as a general matter, that we should, over time, even while I think exercising discipline in our lending operations, we should be able to deploy that capital in the form of balance sheet growth organically at rates that exceed the kind of base rates that you're talking about. If one worked this mathematical exercise out long enough, I think that would change. But I think that our size in relation to those markets right now is so small that we've been able to reinvest all that capital that we retain and do so safely. I think, and this is sort of a broader matter, this is not specific to Hingham, I think that when the ability to reinvest that capital becomes more limited, that's where the question of the growth rate of the company as opposed to the base rate, or in comparison to the base rate of the market, becomes more significant. But I don't think we're anywhere close to that right now. We're still pretty tiny, I guess is what I would say.
Right.
Does that kind of get after what?
Yeah.
What you're
Yeah.
asking? Yeah.
Thanks.
I think that it's also worth saying that there are banking models where the opportunity that they have for growth maybe outstrips the retained earnings that the business is generating. And in those models, you see external capital being raised, whether in the form of equity or subordinated debt, to support that growth. And I think that that's something that, generally speaking, we're fairly adverse to. I don't know that I'd ever say never, but our view is that reliance on internally generated capital is an important governor from a risk and discipline perspective. That's not a criticism of anyone else. That's just sort of an expression of I think, our preference. Thanks, Rob.
Thanks.
I'll see if I can figure out how to send you back down to attendee status, unless you want to hang out. And with that, maybe flip over to some of the written questions. We grouped these as best we could in a couple of different categories. And the first one, I think maybe we'll walk through a little bit, is interest rate risk and asset liability management. This is something that I think is a topic that gets a lot of attention from bank investors and is doubtlessly important. So there are a couple of folks here who asked some questions that are fairly similar, and I'm going to try and kind of group these together. If I don't get it right and you're on the call, raise your hand and correct me. First, Gordon Jung, who had a few questions. And I'll read these directly rather than paraphrasing. Hi, Patrick. I hope you can touch on two topics. The first is inflation. If there's an inflation similar to what we had in the 70s and 80s, how will that impact our bank? I noticed that we changed or doubled our interest rate risk estimation in our 2005 annual report as compared to the 2004 annual report. Could a similar surprise happen again? I think a couple of points here. First, inflation is generally bad. It's bad for banks generally. It's bad in particular for liability sensitive banks, especially to the extent that that inflation manifests itself in the front end of the curve. It is bad if it is unanticipated, which is to say that it's not priced in the forward curves. Having said that, I think that it's important to note, and this relates to a question that Harry Bornstein had, we have always been liability sensitive, and we have always been maturity transformers, and we have always viewed the transformation of maturity from a variety of shorter term funding sources into a variety of somewhat longer term assets as being a core function of the bank. And that is something that we have not changed for, almost 30 years. And it has not been something that we've changed depending on what our assessment, as weakly held as it might be, is of sort of the 1 to 5 year interest rate environment. It's not to say that we're careless about the risks that are involved in managing interest rate risk, but I think that our view is that those that have attempted to remain neutral to interest rate risk have often foregone through the cycle profits that they would have earned if they had recognized that that maturity transformation was a core piece of the business. And I think in some respects, that is the result of some lessons that date back a number of decades now to the S&L crisis, in which there were, I think, a number of takeaways that became common wisdom about interest rate risk that really related to credit risk. So I guess I would say that to the extent that we may or may not be entering a period in which rates are rising, and we've seen a number of those periods before, the focus that we have is not on sterilizing that interest rate risk directly, because the book, particularly the real estate book that we have, moves slowly. It doesn't move overnight. It doesn't take 10 years, but it takes a number of years to reprice. The things that I think we have tried to stay focused on are remaining very, very disciplined about our cost structure, because that is what gives us the flexibility that we need in pricing both sides of the balance sheet as rates change. And B, and this goes to the poorly learned lessons from the S&L crisis that I was just referring to. In that crisis, you had a lot of lenders where their liability costs started outstripping their asset yields, particularly on a spot basis. And that drove them out the credit risk spectrum, or out the credit limb, proverbially, to invest in and lend on securities and projects that had very, very high risks of impairment of capital. And they did that to try and maintain positive spreads. The sort of classic stories of S&L failures in the 80s, particularly the ones that have been documented in Penn Square and the failure of Continental Illinois, were the result of lenders who moved out that credit limb trying to outrace liability costs, and that limb got cut off behind them as banks failed. And I think fundamentally, we view those lessons as being credit lessons, not interest rate risk management lessons. So in the event that we do enter a period in which rates rise either on a temporary basis or as a secular trend, I think the thing that we are very focused on internally is making sure that we are not pushed out or tempted out that risk spectrum, because that is the bank killing risk. So I think it's important to emphasize that. And as to whether the situation we're in now looks like 2004, 2005, I don't know. I'm not sure that I'd speculate on that. But running the balance sheet in such a way that we can be flexible and try to deliver satisfactory returns, even when NIM is under pressure, is something that we think a lot about. That sort of touches on Harry's question. So this is Harry Bornstein, quote, "You've traditionally run a liability sensitive balance sheet. In the event we're entering a secular rising interest rate regime, how are you prepared? Have your recent efforts at deposit gathering been done with this in mind, or is this simply in the interest of lowering your deposit costs generally?" Both. I'll leave the first piece of the question aside. I think I just touched on that. The recent efforts at deposit gathering, I think that we have gotten better over time at recognizing where differentiated value for us on the deposit side is vis-a-vis our customers. And I don't know that I would say that focus, particularly the work that we've done in the specialized deposit group, is really in response to the liability sensitive balance sheet. It's not necessarily an interest rate risk or asset liability management strategy. I think it's a view that we can attract and retain significant non-interest bearing deposits with a model that has some element of differentiation in it. So I would maybe be more of an Eeyore and say that kind of differentiation going forward is required for survival. So it's not even a profit optimization strategy or an interest rate risk management strategy. It's not a question of optimizing those things. It's a question of surviving, because I think that our view is that an undifferentiated model is a model that is under attack and has very, very few competitive advantages in an industry that already has almost none. Another question from Gordon Zhang, and I think that this is something, this relates to NIM and spread, but this is something that we've talked about before, I think is very important. The question, quote, "The second question is on NIM and the spread. Our bank's NIM and spread, as well as the national average NIM, have been in a declining trend since early 2000s. What are some of the drivers and how will they impact our bank going forward?" Please focus more on your proprietary insights and mention as many negatives as possible. I don't know that any of my insights are proprietary, but I have many negative things to say. So I'll touch on that piece of the question. So first, NIM has multiple components. There is the top line component, or the yield on our investments and our loans. And then there is the cost of funding the balance sheet from an interest perspective. And then it's the cost on our deposits and on our wholesale borrowings and wholesale deposit activities. And I would say that the lament regarding NIM compression is one that has been present in the banking industry for a long, long time. Well before my arrival here at Hingham, before my dad's arrival here at Hingham, probably before his arrival at East Weymouth Savings Bank, almost 50 years ago. The long-term efficiency in the markets for money, whether buying and selling money, the long-term trend of efficiency in both sides of that market is something that has been up and to the right for a long time. So those markets are really, they're both getting more efficient, and they have been have been changing so for a long period of time. And I think in thinking about the drivers for those trends, it's useful to kind of disaggregate what drives the pricing in those markets and what are the kinds of frictional costs or transactional costs that have historically existed that have gotten taken out. So if we think about market efficiency for deposits, or market efficiency for loans, or market efficiency for payments, all of these things are kind of a bundle of a variety of different costs, information costs, search costs, transactional costs involved in opening, closing, maintaining accounts, costs involved in transferring money. And if we were to go back 50 years, some of these are regulatory costs in the form of prohibitions on banking across county lines or banking across state boundaries. If we were to go back 50 years, the cost that a depositor faced in attempting to compare alternatives for money, they were very substantial. There were very high search costs. There were very high execution costs to open accounts. Banks had very high costs in reaching those customers. We've got a number of folks from Illinois on the call right now, and Illinois had really one of the longest standing unit banking systems where banks had one branch. They couldn't branch into the town next door. So much of that has been taken out of the system. So you would naturally imagine that on the deposit side of the balance sheet for that component of NIM, that you would see rising pressure over time on all of those forms of funding that would converge on some notional market price for money. And we're in the middle of a long-term trend that is making that market more efficient and is resulting in some convergence on market price. Sort of truly defensible deposit franchises today are far rarer than existed 15 or 30 or 45 years ago. And it's because of those changes, and they didn't start in 2010. They didn't start with the rollout of mobile phones. They're not a function of online account opening or remote deposit capture. This trend is, it probably dates back longer, but the AmeriCard system, which was the predecessor to Visa, was formed. AmeriCard was a 1958 project. The Visa consortium came in 1970. So, the sort of global leader in what I would describe as one of maybe a few global leaders in digital payments, is now 51 years old. It's not new. You know, those changes have been occurring for a long period of time. The same is true on the asset side. The secondary market for residential mortgages, which is an incredibly efficient market now, is not something that started before 2008. For folks that have a sense of history or maybe watched The Big Short and got to learn about Lou Ranieri, it even predates him, right? So that market in which there's a standardized national market for that asset in which it can be bought, traded, sliced up, moved around, has resulted in a lot of pressure for those kind of assets. And we've seen that efficiency move up market into different classes of assets. So particularly in the last 15 years, the willingness of the agencies to compete for multifamily loans at smaller and smaller sizes has been something that's placed tremendous pricing pressure on multifamily assets. And when you look at the distribution of credit for multifamily, if you were to look 20 years ago, the agencies are not a meaningful player. If you were to look 15 years ago, there's a small amount of origination they're doing. If you were to look now, they're really the 800-pound gorilla in that market. It's no longer the banks. So those pressures will just keep they'll keep pressing both the funding and the asset yields over time. And so NIM compression is a permanent story. And what that means, getting back to something I said a few moments ago, is that banks are fundamentally price takers. They are not price makers. So there are things that can be done at the margins, pun intended, to delay or offset some of that compression. But in the long run, in a commodity industry, for the most part, everyone is selling catch-up. So you need to have a very disciplined approach to costs and process to not only survive, but I think deliver acceptable returns. I'm going to flip back over to the question and answers. So a couple of these. Andrew Dixon asked, what would be the main impact of rate rises or Fed tightening quicker than expected? Could there be a 1-2 punch in terms of the deposit side with customers shopping around for higher rates and also a higher discount rate on the equity securities leading to mark-to-market losses? I think that we've seen periods in the past in which the Fed has begun tightening, whether on the balance sheet side or via the interest on excess reserves mechanism. And I think that generally speaking, we've talked about how we're liability sensitive, and the front end of the curve moving very quickly against us is something that is temporarily quite negative, in the same way that in 2020, our liability sensitivity allowed us to exploit some of the changes in the funding markets and do so profitably. The reverse is true. So I don't want to prognosticate about the future, but I would say I think it's important for everyone to remember that 2020 was a uniquely favorable year for the bank from a funding perspective. And I can't say what that would look like going forward, but it should be understood in that way. It was uniquely favorable. Chris Crawford, do you opportunistically exit investments in your equity portfolio? For example, if they become overvalued, or do you think of them as strategic or permanent holdings? I would say that more often than not, we have viewed them as permanent. There are some that we've owned for a very long time and continue to add to. And part of this is a function of our capacity to appropriately diligence and understand and form opinions about businesses as business analysts first, and then think about them from a price perspective. The instances, and I guess what I mean by that is that our capacity to do that is somewhat limited. And that's not necessarily a reflection of skill, although it might be. It's just we have a relatively small team, and we balance this with the core business operations. So generally speaking, I think we have probably let them run a little bit, even when, maybe I had a perspective that that they were outstripping what reasonable value might be. I think the instances in which, in thinking about sell discipline in our equity investment operations, the instances in which we have either been quick to sell or probably should have been quicker is when there was an element of the underlying thesis regarding the business that changed materially. So in some cases, I think I got this right. And there was something about that thesis that changed, and we sold an investment. I think that was a learning from some instances in which, maybe I didn't see that change play out in the financials, and I waited too long. And I think over time, we've talked about learnings in terms of how we manage our equity investments. I think one of the learnings that has become more important to me over time is that, not waiting when we see the thesis break, and being more tolerant when some companies that we have had investments in perhaps outstrip what reasonable value would be. And so I think that we're opportunistic, but I think that probably we err on the side of caution in terms of selling for valuation reasons. And we've gotten better at moving with alacrity when the thesis breaks, regardless of whether that's being reflected in the financials of the business yet or not. And that usually relates, I would say, to capital allocation. There are maybe a couple of other things that would fall into that bucket, but that's the one where I think we've had some learnings. Okay, Andrew Dixon, how do you see the office collateral in the commercial book over long term in light of work from home and companies potentially occupying less office real estate? This could probably occupy all afternoon. I think I would say that, when we have looked at office transactions in the past, it has not been a favored asset class for us. We've always been focused on either multifamily assets or multifamily assets with a significant mixed use component. And so the office assets that are in the book tend to be properties that are owned by very strong sponsors when there is a high level of tenant concentration. And in some cases, those are owner-occupant properties where the sponsor strength and the leverage point, I don't want to say that it makes us indifferent to the trends that you're talking about, but it provides us with a very, very substantial margin of safety relative to what those values might do. There are other office assets that we have lent on that are more diversified in terms of the tenant mix. And I think maybe more importantly, in terms of the floor plate and the configuration of the space. So for folks that are familiar with office assets, one of the real challenges with the office and retail asset classes is that there can be very substantial periodic capital expenditures required to re-tenant and release those buildings. And those expenditures can be more substantial the less diversified that asset becomes. So if you have a very large office building that is occupied by a single tenant and you are taking that building back as an owner or as a lender, but really as an owner, the capital expenditure you would need to make either to release that building to another single tenant or to reconfigure that office space so that you're working with smaller floor plates could be very, very substantial. And I think when we've thought about underwriting those office assets, those are things that we've tried to avoid. Okay. I'm going to switch back to some of the pre-meeting questions. I'm not sure this individual would want their name attached to this, so I'm just going to do this anonymously. And these sort of fit in the credit and lending buckets. So first, in 2016, I think these numbers are correct, but I haven't vetted them, so I leave him responsible for these. In 2016, residential loans totaled $652 million, or 41% of the loan portfolio, while commercial non-construction loans totaled $796 million, or 50% of the loan portfolio. In 2020, residential loans totaled $630 million, or 25% of the loan portfolio, while commercial loans grew to $1.7 billion, or 67% of the loan portfolio. Has the bank strategy been to maintain the residential portfolio while growing the commercial portfolio? Or can you provide some color on why the commercial portfolio has grown so much relative to the residential portfolio? The answer to the first question is yes. That has been our strategy. And I think there are a number of reasons why that is the case and why our preference for commercial assets, particularly multifamily assets, why that preference has shown out in terms of portfolio composition. So first, particularly focusing on the multifamily and mixed use assets, they have better leverage characteristics. So we're doing those transactions at much lower loan to values than your average residential loan. Your average residential loan in the United States, probably 80%, maybe a little bit higher if you include the government-sponsored programs, whereas the leverage points that we're looking at on multifamily assets, we max out at 75%, but in reality, the leverage points both on new loans in the portfolio are quite a bit lower than that. Those cash flows are diversified as opposed to being dependent on one or potentially two individual sources of income. So from a credit perspective, we like that. There are better legal terms for those commercial loans than there are in the residential market. I think the last year has made that quite clear. Our ability to exercise our remedies if something goes wrong, that ability is far more substantial on the commercial side than it is residentially. The business has more opportunities for us to differentiate ourselves in a relationship with a customer than the residential market does. That doesn't always manifest itself in pricing leverage, but it can result in us doing that loan as opposed to someone else. And I think most importantly, the business has more attractive reinvestment characteristics, which is to say, as I said before, there are probably some folks out there that have 5 houses, but it's a very small number, and there's no business that's going to be built lending to those folks. Whereas in our multifamily business, we have some larger institutional customers, And we have individuals that have just bought their first 2 or 3 family or 4 family home. And those investors over time buy a second property and a third property and a fourth property. They go into business with their families. Their kids come into that business, their daughters work with them or their sons. Those portfolios grow. They roll portfolios of 2s and 3s up into larger properties, 10s, 20s, 50s. Sometimes they don't. We've got a few customers that have really tremendous portfolios of 3s and 4s and swear they'll never buy anything with common space, but their businesses have sort of attractive growth characteristics if they're managed appropriately. And to the extent that we have good relationships with those customers, we get to keep reinvesting capital over time in the form of lending to them. And that's something that I think we find is really attractive. Another question from the same individual. Let me scroll down a little bit. Can you walk us through the underwriting process? Also, does Hingham have an internal group that reviews appraisals and/or provides internal valuations on properties? Lastly, can you provide some color on how the loan approval process will change as the bank grows? So I'm going to focus on the commercial side here because I think that's really where the meat of the matter is. It starts at the very outset with conversations between our lenders and their customers. And those conversations relate to everything from I have an asset, I'm looking at refinancing debt on it, to I'm thinking about buying something. What do you think about it? Here's how I'm thinking about valuation. If I need to move quickly on this, how are you guys thinking about it? How would you think about valuation and how would you think about structure and terms? And so at the very front end, those early conversations are very informal. As that moves through the process, there are conversations the lender would typically have very early on with either my father or myself with respect to valuation and structure. And that conversation is really giving the lender and the borrower some insight into how we're likely to value that property and structure that loan when we get to our executive committee and our board. Our executive committee, which is half of our board of directors and a very substantial portion of the equity in the company, reviews every loan from $0 up to the legal lending limit without exception. So there is no internal lending authority for commercial loans at the bank. I can't make them. My dad can't make them. Lenders can't make them. We can't make them together. There's no log rolling. Everything goes through the executive committee from $0 all the way up to the top. We meet every 2 weeks. There is a fairly comprehensive package that the lender assembles. It's distributed electronically. For loans in excess of 1.5 million or for any loans regardless of size where the credit relationship inclusive of that loan would exceed $6 million, we look at that loan at the full board of directors. And we don't review it after the fact. We don't ratify it. We don't ratify an officer's approval of it. We have a discussion about the collateral, about the structure. All of those loans are approved by the executive committee and the board. 99% of them are approved by the executive committee and the board without reviewing a third-party appraisal first. So they are reviewed using an internal estimate of value that the loan officer is responsible for devising, and that the executive committee and the board sort of, I think, very energetically challenge and underwrite themselves. And I think it's very important culturally when we think about our underwriting process to note that we don't rely on the borrower's estimate of value, and we do not rely on the appraiser's estimate of value until we have formed an estimate ourselves. We cannot and we do not outsource that valuation task. That's core to what the committee and the board are doing. We approve those loans subject to a third-party appraisal of not less than X. X being our internal estimate. Frequently, that appraisal comes in higher. The loan amount will not change. And I think that's an important piece of the underwriting discipline that we've talked about before. In terms of changes going forward as the bank grows, this is a system that we've had for almost 30 years. We've moved some of the limits over time, particularly the board of directors, the limit that they employ to review transactions. I think that it's likely that those limits may change over time and rise as the bank grows. But I would note that there are a lot of features to that process that we have gotten more efficient at over time that improve the ability of the executive committee and the board to review a higher volume of transactions and do so on a meaningful basis. So 10 years ago, the executive committee meets every 2 weeks, the board every month. There would be a process to assemble these packages physically. They were fit into 3-ring binders. Those binders were distributed via FedEx to all 8 members and then 16 members of the board on the Friday before those meetings. As you can imagine, this is a very labor-intensive process and put certain practical restrictions on the ability of those bodies to evaluate loans, and we made changes. We digitized that process. We continue to improve those processes. So I'm somewhat sanguine that we can maintain what to us is a very important cultural element of our underwriting process, and we can do so for a long period of time by adjusting how we do the process and make it more efficient. I wasn't there for it, but my dad has told, and maybe now he could tell the story of a lender that either interviewed with us or he may have worked for us briefly, Dad, who believed that we would never be able to grow using this system.
Yes, that was back in approximately 1995, and that particular lender, we were at the time about 175 million in total assets. And that lender assured me that we could not grow at all with this business of having a committee of directors looking at our commercial real estate loans every 2 weeks and approving them. He wanted loan authority and assured me that we just couldn't move forward unless he was given that authority. Of course, he was never given that authority, and his suggestion was obviously proven to be an inaccurate one. And I know you've mentioned to me some significantly larger banks that multiples of our size, many multiples, who on loans of a significant size have had at least one of their executive committee directors putting actual eyes on those properties before the credits are approved. So I fully agree with you, Patrick, that it is very deeply ingrained in our culture. And while it may need to be modified in terms of loan amounts going to the board of directors, I don't see any change in the foreseeable future in the executive committee's role in reviewing every single commercial real estate loan.
I'll go back to the written list. A couple of questions, and I'm not going to attribute these by name, regarding the loan to deposit ratio. Folks correctly noted that generally we've run at what is a higher loan to deposit ratio than is typically seen in the industry. And why is that? What are the sort of potential risks of that model? As to the why, I think it reflects our view that a mixture of wholesale funding and let's say direct funding is appropriate to minimize the total cost of funding the operation, right? So really what needs to be optimized is the total cost to fund, which is interest expense and non-interest expense together. And I think that some judicious use of wholesale funding, I think this has been our perspective for a long time, is key to optimizing that mix. Because the non-interest expense of using wholesale funding is so much lower. I think that there are traditionally two types of risk that that folks associate with that kind of balance sheet structure. The first relates to pricing, which is a historic view that wholesale funding is more expensive. And I think historically that has been correct over long periods of time from an interest perspective. And I think the other view is that there is some execution risk there. So to the extent that you're relying on wholesale funding, one needs to be sensitive to counterparty strength, to availability, to the term structure of that funding. And this sort of a classic over-reliance by banks or companies on commercial paper markets to fund their operations. And one day it's not a question of price, the funding simply isn't there. And I think that those are real risks, particularly the execution or the counterparty risk. And I think that's something that we're sensitive to. Although the way in which we've structured our wholesale funding in the past, particularly our use of the Federal Home Loan Bank, has been designed to, I think, minimize that risk. And a lot of the diversity that folks see in those funding sources in the last several years are designed in turn to give us some greater comfort that we can execute in a variety of different markets if the Home Loan Bank were not available. Having said that, our funding at the Home Loan Bank now is probably, what was it, a 10-year low? I don't know. It's very low. Our drawn capacity at the Home Loan Bank relative to our undrawn capacity, or what you could think of as kind of our credit line based on the mortgage portfolios that we pledged there, is very, very low right now. I think the pricing risk is a more interesting one to think about. And I think I would turn the question around a little bit. I would say that if the kind of long-term structural drivers that we talked about earlier in terms of market efficiency for funding persist and intensify, then the real risk isn't to banks that have constructed their operations to be profitable when they are paying wholesale market rates for funding. The real risk is to banks that have not designed themselves to operate profitably while paying those kind of interest costs and have deposit operations or franchises that do not have some kind of differentiating competitive advantage that allows them to maintain very low interest costs in the face of that kind of competition. There are some banks out there that have that. We don't need to talk about them by name, but I think that they are far fewer than folks would like to believe. So I think our view is that the real risk in light of those market forces is that you're not able to operate efficiently if you need to pay what the market demands. So I think we think about that risk maybe a little bit differently than is conventional. Well, this is an interesting one. So Yossi Zluf, a longtime shareholder from Israel. What's the next size hurdle that would increase regulation over the bank? And what could be the effects of such an increase in the efficiency ratio and returns on equity? I think it's probably worth sort of describing at a high level some of the areas where there tend to be step function changes for regulatory structure for smaller US banks. There are some changes that trigger at $1 billion. which relate in particular for public banks to fiducia and SOX. And that relates to changes in kind of control environment that you need relating to financial reporting. The reality is that I think most banks, even below $1 billion, have made these changes. You know, SOX is now 17 or 18 years old. I don't know, Marty or Matt would remember the year, but I think I'm close enough. And so I don't think this is really a major one for U.S. banks anymore. $3 billion is another kind of bright line where the exam cycles for well-managed and well-capitalized banks will shorten up, although I don't know that I would think of that as a meaningful expense in the context of the efficiency ratio or returns on equity. There are some changes at that level relating to the treatment for capital purposes of subordinated debt raised at holding companies and downstream to owned banks. That doesn't apply to us. We don't have a holding company, but there is some favorable capital treatment that's afforded to smaller banks that have holding companies that can raise sub debt at the holding company, downstream it to the bank to shore up the bank's operations. The Fed has a policy statement that they don't regulate those banks and the bank holding companies on a kind of consolidated basis for capital purposes. So there's some advantages that go away at $3 billion. We won't be subject to that. There are a series of major changes at $10 billion. $10 billion is a number that you'll hear a lot about in reading about the cost impacts of bank regulation. I think that the 10 billion number can be disaggregated probably into a couple of different pieces. The first is the impact of the Durbin Amendment and the cap on debit interchange. So the Durbin Amendment provided for provided exemptions for banks below 10 billion in terms of the debit interchange they collect on the issued debit cards in their consumer portfolio. That revenue is capped at 10 billion. That can be a very, very material revenue line for a lot of banks that have a substantial consumer business. It's probably the largest financial impact that crossing 10 billion has. Two banks over 10 billion are separately regulated on the consumer compliance side by the CFPB. And three, there's really a bundle of risk management enhancements that are expected by regulators at that level. Some of which have weakened in the last few years relating to stress testing, but I think I would be confident that they're likely to return. So in our context, I guess I would say that our asset size, I don't see sort of any near-term hurdles that would result in step function changes in regulatory costs. I think I would say that if you are growing, if you are a commercial real estate concentrator, there are investments that you need to be making in risk management, and you need to be making them well in advance of being told to make them or being required to make them. And I think that that's something that we're sensitive to and we're always doing. Right? In thinking about the efficiency ratio, there is a difference between being frugal and being cheap. And being cheap in a regulated business is often being stupid. So when it comes to risk management, either on the credit side or in terms of the analytics that we do for interest rate risk management or liquidity, portfolio, RBSA obligations, those are areas where the checkbook is opened and we spend fairly freely. And that's not something that starts at 10 billion. And I think to the extent that those are processes, not expenses, they need to be developed well in advance of that. So I guess I would say, I don't know whether there's a particular size hurdle that we'd cross, but investing in those things so that we can continue to grow and maintain what we think has been a very important relationship that we have with the regulators. That's something that we'd never skimp on. Brian Werble, what average ROE is likely achievable for the next 10 years? Why are the equity investments made not identified by name? Your wonderful business and reporting are much like Mr. Buffett's, but the lack of transparency regarding these equity purchases makes it a little harder for me as an outside shareholder to fully understand the portfolio risk. So maybe two things here that I'd like to touch on. The first is that, I think it's probably not responsible for us or for me to predict what kind of ROE would be achievable over the next 10 years. I think to the extent that my family and I maintain, very sizable investments here at Hingham, both in absolute terms and, in relation to our family's net worths, you could probably guess that I think that the prospects for generating sustainably high returns on equity without taking undue risk over time are decent, or at the very least, I think that it is possible we could do that. But to the extent that is a possibility, it will require a lot of hard work. It will undoubtedly require solving for challenges that we did not see in the first 10 years, the second 10 years, or the third 10 years of our time here at Hingham. So I certainly think it is possible those returns will be satisfactory to us, and that's why we're here, and that's what we'd like to do. But I'm very hesitant to sort of speak to that. There's well, for bank investors, this may resonate. I don't want to name names, but it's so egregious that I'll talk about it somewhat specifically. There's a bank that frequently gives a guidance with respect to EPS 5 to 6 years into the future. And I think that is absolutely inappropriate. So in thinking about what we could do over the next 10 years, I'd like to do well. We're going to try and do well. I think it's possible to do well. It's going to take some hard work, but I'm not going to predict what we're going to do, and I'm not going to say what I think is likely achievable. With respect to the investment portfolio, this is a question that we talked a little bit about last year. I think that our hesitancy, and really I'll own it, my personal hesitancy in naming some of the individual companies in which we have invested over time relates to probably two factors. The first is that historically and even now, our core business is in commercial real estate lending and in personal and commercial deposit gathering. And in thinking about the opportunities for growth, in thinking about the real risks to the business in terms of the bank killing risks, they really are in those businesses. So in thinking about where we want to emphasize our disclosure, our communications, where we want to spend the time during a meeting like this, I enjoy speaking at a higher level about our philosophy in terms of selecting those investments, in terms of how we think about portfolio construction, in terms of how we have thought about sales over time, or maybe thought about sales inappropriately or wrongly, or where we've learned. I think that it is absolutely appropriate to talk about instances at a higher level where we've benefited from the interaction of those two activities, where we've benefited in the core business from our investment operations and vice versa. But I've been somewhat hesitant to discuss those holdings by name, in part because of the kind of commitment bias that would attach if we started discussing them, in part because I would prefer to focus the discussion on where I think the most substantial risks are to the bank, and that really is in the lending business. It is made more complicated by a second factor, which is there are some instances in which we may not be done purchasing. They're relatively small companies, and I don't think that it would be advantageous for our shareholders if I were to necessarily discuss some of those holdings, some of which are smaller in the context of the portfolio, but it is very difficult to open the door just a little bit there. So I think I've adopted a perspective that is a little bit more, I really don't want to disclose or get into the business of discussing individual holdings. There have been exceptions last year. Some of the very large, very liquid, longest standing investments that we have in some payment firms, we talked about a little bit. So I think I would say there will be a point at which we will have some required disclosures via 13F, not this year, but at some point in the future. I think that, may be an opportunity to discuss some of those things in greater detail. We've also had conversations internally, and I haven't really settled my mind on this, about potentially disclosing some of the larger and more liquid investments and anonymizing those companies where we may not be finished and where there may be a disadvantage to our owners to disclose the names of those companies. So I don't know that there's sort of there's a settled perspective on it. It's something that we're kind of working out as we go, but I think that should give you some sort of sense of where our thinking is on that. That takes us through, I think, all of the written questions that we received before the meeting. There are a number of questions in writing that we still have here in the Q&A. Dad, I don't know how much of this you'd like to work on here, and if we can't get to it, I know we're at 5 o'clock, and I know we said this would be a 3 to 5 meeting, and our board of directors will be meeting after this. I think we could probably address some of these maybe in writing and do that via an 8K and get that out. I hate to cut this short.
Yeah, I agree with you. I really appreciate the shareholder participation that we've gotten this afternoon, which I think is great. Some very, very good questions. And I think the questions covered, and I'm not seeing the additional questions, but I think the ones that you've responded to and your fulsome responses may have already addressed a number of those. So I think your suggestion that unless there's something quite unique about any of those remaining questions, I think we're close to the point at which we should move on.
Well, boy, now you've put me in the position of saying these questions are not unique, so now we need to answer them.
No, don't say that. They, if they're generalized questions with regard to the operation of the business that you've already touched upon and you've covered.
Here's what I'd say, and I apologize. You're going to see my phone come up because I'm not quite
Yep.
sure how to shot while I'm in.
Good.
What we're going to do is we're going to take, I think we've got 6 that are open right now. We're going to take these offline and develop some responses in writing to these, and we'll do those via an 8K.
Good. Excellent.
Lucas, Jimmy, Arturo, Harry, and a 6th questioner, Rohan. I apologize we didn't get your questions. But Harry, you already got one, so I apologize to the other 5, and for these we'll get some out via an 8K. Again, I apologize that we didn't get to some of this because some of this I think some of this is kind of interesting. You want to know something, Dad? I'm gonna touch on one thing here.
You want to let me answer them? I'll do it quickly. No, I'm kidding.
Yeah. So I think the one I want to touch on actually came from someone anonymous. So I'm not sure if folks can see the questions in the Q&A, so I'll read it out loud. with regards to Hingham's approach to lending and asset quality going forward, would both Robert, Goggin, and Patrick provide their views of what has or has not changed as a result of the pandemic over the past 12 months? Are you applying a different margin of safety for different loans? Do you think of exposures to your CRE loans differently? Why or why not? If nothing has changed, what evidence are you seeing that a return to normal is the future result? Dad, I'll let you touch on that first, and then I'll share some thoughts, and then we'll wrap it up.
Okay. I would say in terms of as a result of the result of the pandemic, in substantial measure to me, is to confirm my belief in the quality of our portfolio. As I mentioned when I was talking about Kelly Conley, we had the lowest level of forbearance and modification as a result of COVID of any $2 to $4 billion bank in the country. I think that speaks for itself. You know, we told folks that on the commercial side, if you can pay, you must pay. And I have to assume that that our competitors, if their customers were capable of paying, they may have encountered a similar response. Many of them were not capable of paying. And I think that has to do with our underwriting over a long period of time. So I don't think we're changing that much. You've commented on the office component, and we're certainly, we have long been, had greater concerns about that a piece of the commercial real estate portfolio. That's why it's relatively small. And to the extent that it has grown, it's been with some very strong national borrowers at very low LTVs. So we've also been stressing our portfolios. You know, we've got some very sophisticated stress testing that has been implemented. And in addition to that, on our new originations, we're looking very hard at rent rolls and what impacts those rent rolls may be experiencing or may experience in the coming months. So we are stressing them a little bit differently at origination than we might have pre-COVID. But those are the only observations that I would have with regard to our lending and how COVID has impacted our thinking. Patrick, you may have something else to add to that.
So, you know, I think what I would add to that is that we, this is something we talk about a little bit in the annual report, but it really can't be understated. From a sort of the highest level in terms of capital allocation to our recruiting and our investment in people, to the relationships that we have built on both sides of the business, particularly on the lending side, through to the individual transactions that we're underwriting and structuring and either, you know, making loans or not making loans. You know, we're operating in a business that requires, in my opinion, long-term thinking at each one of those levels. So when we're thinking about allocating capital in a commercial real estate lending business, that requires being committed to underwriting those assets with a longer term perspective, to being willing to hold those assets, to being willing to build relationships with borrowers such that we are active in those markets, both when times are sunny and when it is raining, like today in Hingham. And so I don't want to say that the pandemic hasn't changed my views about how certain assets might perform, but I think that we've oriented our business around some very long-term bets about the sustainability of cities. And those bets are tied to some long-term drivers for why cities have grown in the way that they have, why they have been centers of economic, cultural technological innovation and progress, and why those factors are likely to persist over time. And that's a larger conversation than, the question of whether a tenant in a particular retail property is paid or not paid, or had difficulty during the pandemic or did not. I think that it is linked to a longer term question about where we think the most attractive returns for us are likely to be over a long period of time. And so, I think we have traditionally been very disciplined underwriters. Everyone says that. I think we have been. I think the last year has proven that out. But I don't think that there are likely to be major systematic changes in the attractiveness of cities because of COVID-19. And I think in looking over time at the impact of pandemics on cities, those short-term impacts have always been swamped by what are very powerful long-running forces that have made cities an attractive form of economic organization and living for people. So I know that that's not exactly what the question asked, but it's something that I wanted to emphasize and I wanted to do now and not in an 8K, because I think that it is a very important element of our business. And what it meant in 2020 was when we were having conversations with borrowers, both new and existing, in periods, including in March and April, where credit markets were very much seized up. That seizure didn't last for as long as we thought that it would, but it was there. We didn't have a blanket prohibition on lending on retail properties. We didn't have a blanket prohibition on lending on office properties. We insisted, I think, on substantial margins of safety in some of the larger transactions that we did. But in underwriting the transactions and thinking about the potential for those assets and the rents over a long period of time that were likely achievable and what the fundamental underlying economic bets that we were making were, we were in a position because of that discipline in the past to develop some relationships and then extend some relationships with customers that were, I think, very profitable last year and are likely to be profitable for us going forward, as opposed to what I would say is a maybe shorter term, I might call it a Wall Street Journal approach to underwriting, in which the most recent article on the cover of the Wall Street Journal about either the office market or about the retail market or about student housing or urban multifamily drives a kind of fear-based approach to underwriting. It's not to say that we're not thinking about those factors, but I think that those that have underwritten assets in that way and have entered and exited markets because of those things, those are lenders that I think have substantially damaged relationships with the best customers. They were not there to serve them when they needed it. And I think that that has been to our advantage. I would say, with respect to specific office classes, there is some skepticism that we have of low quality office. I think that was playing out before COVID, and COVID has probably intensified that, as there has been a cultural realization that substantial work can be performed remotely. I would say that it's our perspective that the real question is not whether that work will be performed in kind of lower quality B office in New York City or perhaps in suburban Connecticut, New Jersey, or New York. The real question is whether that work will move from, and this is not specific to New York, I'm using this as an example, will move from the tri-state area to, first Arizona and then all the way offshore. Because once that cultural barrier has fallen in terms of managing remote workers in routine or transactional lines that had traditionally occupied that Class B space, it will not stop simply with folks working in suburban office space or working from home. Companies will optimize different kinds of labor markets. So I think our view is that suburban office is no defense against that long-running trend, and that's something that we haven't had a lot of interest in. So with that, I've got some photos of these questions, and we'll get to work on writing some responses up and getting those out in the next few weeks. I would say on behalf of my dad, and I think the entire board of directors, I would thank all of the shareholders and former shareholders and prospective shareholders and family members, all of which are shareholders, for attending this afternoon. Last year, I made a prediction that we wouldn't need to be virtual in 2021. I was wrong about that, which is why I'm not going to talk about our ROE in the future. I'm not going to jinx it. And I will say I'm confident that we will be in person with a hybrid component next year in April. And we look forward to seeing as many of you as possible here in Hingham. And for those that can't attend in person, we'll undoubtedly have a Zoom component. So thank you everyone for your time. I apologize that we had to cut this a little bit short, in particular to those questioners, those shareholders, and we'll see you next year. Thank you.
Good night, everybody.